From the morning reading, the IWM and Spider close above hammer in the bull flag pattern. Energy gains as oil rallies day 6. Intap jumps 17%. 7 of 9 sectors moved higher on Thursday. XLE, XLU, and XLB were the strongest sectors, while XLF was again the weakest sector. Oil futures jumped $2.02 to close at 48.96, rising for the 6th straight day, nearing its June 9th high of 51.67. Breadth strengthened compared to the prior section as decliners led 2088 to 869 on the New York Stock Exchange and led 1728 to 824 on the NASDAQ. Active investment managers have been more exposed than now to stocks on only one other week since 2006. This week, managers' average exposure level was 99% with high confidence level, low standard deviation among responses, and the most bearish manager was net long. The only other week that exceeded this was January the 30th of 2013. Stocks gyrated for the next month after that, and there was no major negative implication. Generally, though, when the manager exposure is so skewed, there's a contrary reaction in stocks. Hedge funds are exposed too. Hedge fund exposure has increased to 31%, enough to be considered extreme, though it remains above prior extremes above 40%. For comparison, exposure was minus 10% in February. When exposure has climbed above 35%, the S&P's next day return has turned negative on an annualized basis. Even amid the lack of volume, inverse ETFs are suffering. Volume in ETFs that short the market has dropped to the lowest level as a percentage of total volume since February of 2015. Over the past 3 years in particular, this has been an excellent contrary indicator. Thursday's relative lack of interest in hedging suggests extreme complacency among traders. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:56 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 19th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, we have a bit of weakness, but nothing significant. The S&P futures are down about 0.25%. The Russell futures are down about 0.33%. And both the NASDAQ and Dow futures were down about 0.25%. Crude oil was down a little more than 0.33%. Euro also down about 0.33%. Bonds down 0.4%. And then gold down just over 1%. Mixed action overseas. And this date is 8/19 on China. China's up just above scratch. Hong Kong is down about 1/3. Japan up about 1/3. Germany down about 0.5%. And United Kingdom down just below scratch. In terms of macroeconomic reports for today in the United States of significance, it's nothing. In terms of current volatility conditions, short-term VIX down below 10 once again. Skew still elevated, still in the cautionary area, but it is now down below a 135. IV percentiles remarkably low, and with the S&P at a 1, the Russell at a 3, the NASDAQ at a 3, and the Dow at a 1. So very, very, very low IV percentiles running. There were no standard deviation moves put in yesterday on any of the 4 broad market U.S. indices. Let's go ahead and bounce over to the charts. So on the futures, and this is S&P futures, you see we've kind of tickled both sides of the recent channel. And right now, in the overnight action, relatively small action, though bearish. Right now, it'd be a bearish engulfing. It certainly looks very close to that. So a little bit of weakness, but remember, it was just a few points and nothing of real significance so far. We'll see where the cash participants take it once they enter in about a half an hour. The sideways action, though, technically we had a bull flag fire with yesterday's action on the S&P, and waiting for some confirmation and follow through. But for the most part, this is just sideways action in the last couple weeks. Ever since we had this bull flag breakout, it has basically gone sideways with a couple tickles, tickle up, tickle down, right back to where we started. And it seems like that's been the story of the last 18 months, doesn't it? Dow, also in a sideways pattern, also had a bull flag breakout yesterday's action, but primarily have nullified that action thus far today, but not to the point that we've broken down below the horizontal channel. In terms of the NASDAQ probably also broke that bull flag pattern yesterday, but ended up with a doji. Very, very, uninspired kind of action yesterday. A little bit of weakness on all four, of course, of the indices coming into today. Same thing here on the Russell. Now, the Russell's been a little bit more bullish of late in that it's not been in the horizontal pattern like we've seen the others so much. It also had a bull flag activation trigger yesterday, and pretty much all four are backing off from those triggers that would have fired with yesterday's price action. Let's take a look at the other markets. Crude oil has been just rip your face off bullish in the short term, and now has broken above the clouds. So it has climbed up through a whole stack of resistance areas and now has cleared the cloud and basically is now coming into these former swing highs. One of the morning authors mentioned this, but you got the 50.57 area and then the 51.67 area basically as the area of resistance that's up above where you are on current price action. So certainly the pot odds of, how much room you have left to go up before you're likely to have a retracement versus the, the easier path to the downside. Not terribly easy if you're not already in this trade. If you are in the trade, then you're probably wanting to manage some exits, probably take some off just in front of this swing area, and then perhaps have the rest targeting the 51.67 area. In terms of bonds, let's go to bonds. Bonds continues to be neutral. We're in the cloud now and chopping sideways, and we've been in a sideways pattern basically for a month. So nothing really to get us, any indications of market direction with respect to bonds right now. Super, super neutral. We'll take a look at volatility here. Of course, we've been running around a 3-year support base, and nothing has changed on that. So for the most part, the charts, while in recent history we've had some bull flag breakouts on the indexes, they've not followed through at all, and everything else is pretty much sideways with the exception of crude. I do think we may have missed gold. Yes, gold. This is significant. We've been waiting for some sort of response to this triangle, and we've been kind of violating repeatedly this lower edge, but then closing right around the edge. So I've left the triangle in place, but this is a clear violation. So we no longer are looking at that as a triangle, and this is probably denigrated into a sideways channel at this point. So we'll take a look and see where this finally goes. I still expect that gold will eventually break to the long side, but as has been the history of the gold pattern this year, it goes into prolonged periods of sideways consolidation before finally breaking out. Often when it finally breaks out, it's after it gives a real challenge to the bulls, shakes them off, and then explodes higher for the next bullish leg. So gold behaving very poorly from a technical pattern standpoint, but very much like it has acted so far this year. That should be enough on the charts. Let's go ahead and go to the daily report. Not a lot of changes from yesterday. Still, the market trend intermediate term phase opinion is phase 3 bull. Flagville is the descriptor. So certainly bullish there. Our 3 market timing signals. First one coming to us from IBD, confirmed uptrend. That's bullish. Second one from GMI Index, a 5 out of 6 with a buy signal in place since 7-1. The GMI 2 still at a 7 out of 8. And the third mechanical signal coming to us from Stock Charts Decision Point Scoreboard, also from that source, no changes. We still have mixed signals on the short term and on the long term. So when you put this all together, consensus is bullish, but with some indications that would lead us to believe that we could have some sideways chop until we get some decision and better lineup, a better stack of our indicators. And certainly that's proving out on the charts thus far with a lot of sideways chop with a slight bullish bias. Position sizing opinions on both models remain at 100%. Intermediate term market posture still severely strong bulls with a bullish sentiment line that is supporting that. So we're expecting longer bullish legs than bearish legs, but obviously given the current volatility conditions, both of those legs are relatively compressed. Strength of the trend is very strong. Hedge warning status remains at 0+, normal with some cautionary aspects. Special strategy opinions. VIX is in the acceptable window to initiate new positions. We'll continue to watch the you know what? I'm just looking right now. The VIX is at 11.94. So call this actually borderline acceptable. When we go below a 12, the premiums that are available are often pretty low relative to the risk. So if you're a novice trader, you know, you might need to consider this a reduced position size kind of environment. Covered calls and put selling both are in the window for initiation of new position. Right now, the ratio is 1 to 2 for covered calls. 1 strike in the money for every 2 strikes out of the money is the recommendation. And then also for low beta, high beta, 1 low beta position for every 2 high beta positions. In terms of put selling, obviously the best opportunity was to put on some before that bull flag fired. If you haven't already put on some positions, watch the individual charts. Frankly, this is a very sideways pattern right now, and the individual charts might be setting up their own bull flag setups. In terms of specific warnings, we've got several from the volatility group, mostly due to very, very low volatility and the expectation that at some point that will fire and explode into higher volatility. Distribution day count still high at 5 for both the NASDAQ and the S&P. Skew still elevated and giving us a little bit higher probabilities of a large 2 standard deviation move within the next 30 days. Under the trend-based area, these are all strong. In fact, we almost hit over 300 and would have triggered, you know, a good sign there on the new high, new low indicator. Key intermarket risk aversion indicators still in the same position with 3 risk on. None of these super strong, but they are risk on. 2 very wrapped and in a neutral position. So nothing changed there with yesterday's action. Sentiment, somewhat elevated sentiment on stocks, both short-term and intermediate term, and our fear and greed index is in the upper quartile at a 78. So watch for those reversal patterns, but those can, of course, stay there in those extreme settings for prolonged periods of time. In terms of sector specific, we see with yesterday's action, we had some healing. There's a lot more green here, but let's focus on what is not green. Utilities, consumer discretionary, telecom, and healthcare. So a little bit of a mixed bag in terms of a little higher beta versus more defensive sectors. And actually utilities, this is actually an improvement to go to 3 neutral. So kind of keep that in mind. This mostly was about healing yesterday, not deterioration. And indeed, when you look at the percent change in the 1 day, you see utilities was one of the better performers yesterday, but also some high beta areas. You got energy was the biggest performer yesterday at 1.78%, materials at about 2/3%. And here's another defensive sector, staples at 0.28%. Only telecom was down significantly. It was down 0.8%. In fact, we've rotated out of all of our telecom positions in the trading room, and that would seem to be reinforced by this breakdown yesterday. I think that's about it for today. Let's go ahead and wrap this up. We're a little late going to publishing, so we're going to go ahead and scroll. If you see something of interest, just hit the pause button and get the details. Go to the hyperlink, etc. But I'm going to just scroll through these first few slides here and on to the disclaimers, which we always have to do. If you need more time to read the disclaimers, just hit the pause button. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for the next market preview session from Falcon Global for Monday. In the meantime, manage that risk and you'll find that everything else falls into place. And in the meantime, seek to go learn something and good trading.